Coming to the accounting treatment in case of dissolution. Now students, remember the accounting treatment is very clear that all the assets that you have should be sold off and they should be realized in the form of cash. Whatever cash is realized then should be used to pay off the liabilities of the firm, and in case anything is left, then that cash can be used to pay off the liabilities of the partners. So now students, in this case, a particular account which we call as realization account is opened. What is a realization account? Realization account is an account which is opened at the time of dissolution of the firm, and it is prepared only for the purpose of realizing the value of assets and paying off the liabilities of the firm. Now, coming to the accounting part of it, this account serves two purposes. First of all the accounts of assets and liabilities that are there in the balance sheet are closed by transferring to realization account. Now, since the business will no longer exist, no account should exist in the firm. So, all these accounts are closed by transferring them to realization account, and from this account they are sold off. That means all the realizations on account of sale of assets are made through this account. Then whatever cash has been accumulated is paid off to the liabilities through this account, and in case any surplus or deficit is there, it is transferred to partners capital account as profit or loss in respective cases. Now let us move to journal entries. How this transfer is made and how realization is reflected upon through realization account. The first step while preparing realization account is to transfer the assets to realization account. That is the assets which are appearing in the balance sheet. So the first case is when assets are transferred to realization account. The journal entry for this is realization account debited to assets, or I should write it as sundry assets. Now students, remember one thing, that is these values or these assets, they should be shown separately. Like for example, you have building, land, stock. So you should write realization to land, to building, to stock separately. And the value would be book value, that is appearing in the balance sheet. Now remember one thing, all assets are transferred to realization account with the exception of cash account and bank account, because these accounts would now be used to pay off assets and liabilities, so they should not be closed off right now. So what we mean is, we will transfer all the assets to realization account with the exception of cash and bank with their book values. Now when this is done, these accounts will no longer show any balance, that is the account would now be closed off. Now students, the other part or the vice versa part of this is when the value of liabilities is transferred to realization account. The journal entry for this would be when liabilities are transferred to realization account. The entry would be sundry liabilities to realization. Remember, it would be at book value with the exception of certain liabilities, that is except partners liabilities. So now students, all the liabilities basically which are of the outside nature, that is outside liabilities, are transferred to realization account. Partners liabilities like partners capital account, partners loan account, or reserve for that matter, they are not transferred to realization account. After this is done, the next step is that the value of assets would now be realized. That is, assets would be sold off on case to case basis. Let us see what that journal entry would be. Whenever the assets are sold off, the journal entry would be cash or bank, whatever is given to you in the question, debited to realization account. Remember, the amount would be the sale value. The sale value. Now students, there can also be a situation wherein a particular asset has been taken over by the partners. Like a partner actually goes and convinces the other partners that rather than selling this asset to an outsider, kindly sell this asset to me. So in that case, if asset is taken over by the new partner or partner, then the entry would be partner's capital account debited to realization account. That is the agreed value of purchase. Let's say there was a plant or there was a motor car valued at 3 lakh which has now been taken over by partner Ram. So the entry would be Ram's capital account debited to realization with an amount of rupees 3 lakh. Now students, there can be another situation, that is an unrecorded asset might exist in your firm, and now when you are actually selling it off, it is getting you certain amount of money. So in case any unrecorded asset is sold off, then it has to be recorded only in bank account and realization account. So on sale of unrecorded asset, the entry would be cash or bank account debited to realization account, that is value realized. Whatever is the value that has been realized on account of sale of that unrecorded asset. Coming to the entries where liabilities are paid. So when payment for liabilities is made, payment for liabilities. In this case, the journal entry is realization account debited to cash or bank, that is payment made. Students, again, just as in case of assets, there can be a situation where the liability is paid off by a particular partner. So payment for liabilities by partner. In case a particular partner is paying for a liability, the entry would be realization account debited to partner's capital account with the agreed amount. That is the amount that has to be paid off. Then, just as in case of assets, we can have a situation where there are unrecorded liabilities. So these unrecorded liabilities have to be paid off. The journal entries for payment to unrecorded liabilities. For payment of unrecorded liabilities, we will pass this journal entry, that is realization account debited to cash or bank, whatever be the situation, and this is the amount paid. Now students, besides these, there might be certain realization expenses, that is expenses on realization of assets and payment to liabilities, which might include commissions and interest, etc. So those payments have to be recorded. So in case of realization expenses, the entry would be realization account debited to cash in case the payment has been made in cash, or in case it has been made by a partner, so to partners capital account. This is the amount paid. Now students, once all these entries have been posted to realization account, the realization account is then totaled out and it might show certain debit or credit balance. That is, there might be profit on account of realization or there might be loss on account of realization. That profit and loss has to be transferred to partners capital account. Let us now move on to the entries which are done to transfer this particular profit or loss to partners capital account. So the journal entry for transfer of profit on realization to the partners capital account is realization account debited to partners capital account in realization. It would be the amount of profit and partners capital account in their profit sharing ratio. Now students, there can be a situation in which there was loss on realization. So in case there is loss on realization, the entry would be reversed, that is loss on realization. The partners will now have to bear this loss, so the entry would be partners capital account debited to realization with the amount of loss and in profit ratio. That means the old partners, or in fact the partners, will bear out the losses, and in case there are profits they will get the share of profits in their agreed profit sharing ratio.